Hey guys, I am Deric. Welcome to my channel. In this video, I'm gonna explain to you the cost of capital. The capital structure of a firm refers to the specific combination of long-term capital used to finance its operations and growth. When you run a business, you need money. That's what we call capital. The problem is, how to get the capital. There are three sources of long-term capital. First, long-term debt, which comes in the form of bond issues or loans. When company needs money, it can either borrow money from the bank, which is what we call bank loan, or the company can borrow money from the public by issuing bonds. When we buy bonds, we are basically lending money to the company. Second, preferred stock. This is a form of equity. Preferred stockholders are a special group of investors who have special privilege compared to common stockholders. Preferred stockholders will receive dividends before the common stockholders. If the company doesn't pay preferred stock dividends, it is not allowed to pay common stock dividends as well. In the case of bankruptcy, the company will have to sell the assets and pay the preferred stockholders first. Then only it can pay the common stockholders. In short, we say, preferred stockholders have a higher claim to dividends or asset distribution than common stockholders. Next, about common stock, this is another form of equity, that's the shares that we are commonly trading in the market. Under common stock, it has two subcategories. First, retained earnings. Every year when company makes profit, the company will pay a portion of the profit to the stockholders as dividend. The balance of the profit will go into the account of retained earnings. So retained earnings is basically the savings of a company. Second, new common stock. When company needs capital to run a new project, it can issue new common stocks to the public to raise new fund. In short, common stock equity equals retained earnings plus new common stock. For using the funds contributed by bondholders or stockholders, the company will have to pay for the cost. That's what we call the cost of capital. Just like when you borrow money from the bank to buy a car or a house, you will have to pay for the loan interest. Loan interest is the cost of capital. Generally, the cost of capital is the minimum rate of return that a firm must earn on the projects. That means what the company earns must be at least equal to what it pays. At the same time, this is the required return that the company must pay to the fund providers. The cost of capital is used to determine whether a proposed investment will increase or decrease the firm's stock price, that is, the firm's value. If the rate of return is higher than the cost of capital, the firm's value will increase when investing in the projects. If the rate of return is lower than the cost of capital, then the firm's value will decrease. However, the cost of capital is not exactly the same as the investor's required rate of return because of the following two reasons. First, there are taxes. When a firm borrows money to finance the purchase of an asset, the interest expense is deductible for the purpose of income tax calculation, which means for making the interest payment, the company can reduce the tax payment. So the cost of capital is measured based on an after-tax basis. Second, there are flotation costs. Flotation costs are the transaction costs paid by a firm when it issues new bonds or new shares. These include the expenses such as underwriting fees, legal fees, and registration fees. Usually, we calculate weighted average cost of capital, in short we call it WACC, to represent the combined costs of all the sources of financing used by the firm. The weighted average cost of capital is the weighted average of the after-tax costs of each of the sources of capital used by a firm to finance a project. The weights reflect the proportion of total financing raised from each source. Consequently, the weighted average cost of capital represents the rate of return that the firm must earn on its investments to compensate both its creditors and stockholders, each with their individual required rates of return. Now, let's turn to a discussion of how the costs of debt and costs of equity can be estimated or calculated. First, the cost of long-term debt, in short we say cost of debt. The pretax cost of debt is equal to the yield to maturity YTM on the firm's debt, adjusted for flotation costs, which means when you calculate the pre-tax cost of debt, the flotation costs have to be deducted. Bonds' yield to maturity depends upon a number of factors, including the bond's coupon rate, maturity date, par value, current market conditions, and selling price. These factors will affect the YTM or the cost of debt. After obtaining the bond's yield, which is the pre-tax cost of debt, then a simple adjustment must be made to account for the fact that interest is a tax-deductible expense. This will have the effect of reducing the cost of debt. So after-tax cost of debt is always lower than pre-tax cost of debt. Let's take an example. A company is contemplating selling $10 million worth of 20-year, 9% coupon bonds with a par value of $1,000. Because current market interest rates are greater than 9%, the firm must sell the bonds at $980. Flotation costs are 2% or $20. What is the pre-tax and after-tax cost of debt for this company? Assume 40% tax rate. Alright, to solve this problem, we will use the Financial Calculator app. By using Bond Calculator, set compounding to annually. PV is the net bond price, taking $980 minus $20 the flotation cost, you'll get $960. That's the money that the company will receive for issuing bonds. PMT, the annual coupon payment, taking 9% times $1,000 par value, you'll get $90. The company will pay the bondholders $90 coupon interest every year. FV is the par value, or face value, or future value of the bond. The company will pay the bondholders $1,000 at the end of maturity. N, years to maturity, equals 20 years. Last step, press yield, you'll get the yield to maturity or IY equals 9.45%. This is the pre-tax cost of debt. To calculate the after-tax cost of debt, we apply the formula, pre-tax cost of debt times 1 minus T, where T is the tax rate. Taking 9.45% times 1 minus 0.4, 40% is the tax rate, you'll get the after-tax cost of debt, 5.67%. Take note that the after-tax cost of debt is lower than the pre-tax cost of debt. Let's take another example. A company issues a $1,000 par, 20-year bond paying the market rate of 10%. Coupons are semi-annual. The bond will sell for par, that is $1,000, since it pays the market rate, but flotation costs amount to $50 per bond. What is the pre-tax and after-tax cost of debt for this company? Assume 34% tax rate. By using Bond Calculator, set compounding to semi-annually. PV, the bond price, $1,000 minus $50, equals $950. PMT, annual coupon payment, 10% times $1,000 par value, equals $100. FV, the face value or par value, $1,000. N, years to maturity, 20 years. Last step, press yield, you will get 10.61%. This is the pre-tax cost of debt. To calculate the after-tax cost of debt, we apply the formula, pre-tax cost of debt times 1 minus T, where T is the tax rate. Taking 10.61% times 1 minus 0.34, 34% is the tax rate, you'll get the after-tax cost of debt, 7%. Second, the cost of preferred stock. The calculation of the cost of preferred stock is pretty straightforward. Let's look at the formula. KPS is the cost of preferred stock, taking preferred dividend over preferred stock price. For PPS, it is the net price or net proceed, which means the flotation costs have to be deducted. Let's take an example. Preferred stock of a company pays a dividend of $8 per year, with a value of $75 per share. If flotation costs amount to $1 per share, what is the cost of preferred stock? By applying the formula, KPS equals dividend over net price, so we take $8 over $75 minus $1. $1 is the flotation cost, you'll get 10.81%. This is the cost of preferred stock. Next, let's look at the cost of common stock. There are two forms of common stock financing, which are retained earnings and new issues of common stock. Retained earnings is also known as internal equity. For using retained earnings, which is the company's own money, there will be no adjustment to flotation cost. Another form is new issues of common stock, which is also known as external equity. Adjustment to flotation cost is needed. The company has to incur transaction costs for issuing new common stock. Generally, cost of internal equity is lower than the cost of external equity because internal equity has no adjustment to flotation cost. To calculate the cost of common stock, there are two different ways, either dividend valuation models or the capital asset pricing model, CAPM. The dividend valuation models are based on the present value of all future dividends, while the CAPM is based on the risk-free rate, stocks beta, and market return. Under constant growth model, cost of common stock, KCS, equals D1 next year dividend over P0 current stock price plus G, the growth rate. G can be calculated by taking ROE times retention rate. If the company pays out 40% of its profit as dividend, keeps 60% as retained earnings, then 60% is the retention rate. Take note, P0 is the net price or net proceed, which means the flotation cost has to be deducted. Another formula is CAPM. By taking RF, risk-free rate, plus beta, times RM minus RF, RM is the market return, you will get the cost of common stock. For example, assume a firm has just paid a dividend of $2.50 per share, expects dividends to grow at 10% indefinitely, and is currently selling for $50 per share. What is the firm's cost of retained earnings? Here we'll apply the formula of constant growth model. The firm has just paid, it's a past tense, so $2.50 is D0. To get D1, we take $2.50 times 1.1. 10% is the dividend growth rate, over P0, $50, plus 0.1, the growth rate, you will get the cost of retained earnings, 15.5%. Another example, for the same firm, if the 3-month T-bill rate is currently 5%, the market risk premium is 9%, and the firm's beta is 1.20, what is the firm's cost of retained earnings? Based on the CAPM formula, RF is 5%, beta is 1.2, market risk premium is RM minus RF, given 9%, you'll get the cost of retained earnings, 15.8%. Based on the constant growth model, the cost of retained earnings is 15.5%. But based on CAPM, the cost of retained earnings is 15.8%, which is slightly higher. So these two examples indicate that our estimate of the cost of retained earnings is somewhere between 15.5% and 15.8%. At this point, we could either choose one of the estimates or average the two. Using some managerial judgment and preferring to stick to the high side, we will use 15.8% as our final estimate of the cost of retained earnings. Next, it is an example of calculating the cost of new common stock. Taking the previous example, the firm has just paid a dividend of $2.50 per share, expects dividends to grow at 10% indefinitely, and is currently selling for $50 per share. How much would it cost the firm to raise new equity if the flotation costs amount to $4 per share? By applying dividend growth model, D1 is $2.50 times 1.1 over P0, $50 minus $4 to get the net price, plus growth rate 0.1, the cost of new common stock equals 15.97%. Compared to the previous example, the cost of new common stock is higher than the cost of retained earnings because of the flotation cost. Next, let's look at another example. A firm's common stock is selling at $40 per share. It paid $4 as dividend last year and follows a policy of paying 60% of earnings out in the form of common stock dividends. If the company can earn a return on equity of 15% and pay a flotation cost of 20% to issue additional common stocks, what is the cost of internal and external equity for this company? First, you need to calculate the growth rate, G. Taking return on equity times retention rate, return on equity is 15%, payout ratio is 60%, so retention rate is 1 minus 0.6 equals 0.4, you will get growth rate equals 6% or 0.06. For calculating the cost of internal equity, just take $4 times 1.06, 6% is the growth rate over $40 plus 0.06, cost of internal equity equals 16.6%. While for the cost of external equity, the calculation would be similar. The only difference is to deduct the flotation cost, 20%. So the net price will be $40 times 1 minus 0.2. The cost of external equity equals 19.25%. As we said, cost of internal equity is lower than the cost of external equity, because internal equity has no adjustment to flotation cost. After calculating the individual costs of capital, now we can combine them to get the weighted average cost of capital, WACC. WACC equals cost of debt plus cost of preferred stock plus cost of common stock. W is weightage, D is debt, T is tax rate, P is preferred stock, and C is common stock. As a basic principle, firm should accept any project with a return which is more than WACC. In other words, the minimum return for a project must be at least equal to the WACC. The following is an example to show you how to calculate the WACC. This is a long question. At first it might look confusing, but you just have to classify the information provided in the questions into different groups, then you would be able to get the answer. Let's do it now. A firm has the following capital structure which it considers optimal: debt, 30%, preferred stock, 18%, common stock, 52%. These are the weightage of each source of capital. The firm paid a dividend of $2 per share last year, and its stock currently sells at $80 per share. $2 is D0, $80 is P0, classified under cost of common stock. Here we mark them with green lines. Tax rate is 35%, this is T, classified under cost of debt. We mark it with blue line. Investors expect earnings and dividends to grow at a constant rate of 12% in the future. 12% is the growth rate, classify under cost of common stock. We mark it with green line. New common stocks have a flotation cost of 12%, classify under cost of common stock. We mark it with green line. New preferred stocks would be sold at $100 per share with a dividend of $9. Flotation cost is $6 per share. These are for calculating the cost of preferred stock, marked with purple line. For debt, it is a 9% irredeemable debt with a current value of $1,100. Annual interest payment has just been made. These are for calculating the cost of debt, marked with blue line. What is the weighted average after-tax costs of capital of the company? So first, for the cost of debt, we'll apply the formula of current yield, taking coupon interest over bond price, 9% irredeemable debt, so coupon interest equals 9% times $1,000 par value equals $90, taking $90 over $1,100, you'll get the pre-tax cost of debt, 8.18%. 8.18% times 1 minus 0.35, the tax rate, you will get after-tax cost of debt, 5.32%. Next, for the cost of preferred stocks, net proceeds or net price equals $100, minus $6 equals $94. So the cost of preferred stocks equals $9 over $94 equals 9.57%. Lastly, for the cost of common stocks, net proceeds or net price equals $80, times 1 minus 0.12, 12% is the flotation cost, net price equals $70.40. Then the cost of common stocks equals D1 over P0 plus G, $2 times 1.12 to get D1, P0 is $70.40, G equals 0.12, so the cost of common stock equals 15.18%. To calculate the WACC, we take cost of debt plus cost of preferred stocks plus cost of common stocks. 0.3 is the weightage of cost of debt, 0.18 is the weightage of preferred stocks, and 0.52 is the weightage of common stocks. So, the WACC of this company is 11.21%. Let's take another example. The market values of common stocks and bonds of a company are $150 million and $35 million respectively, in which the required return for common stocks is 17% whilst 7% for bonds. The book values of common stocks and bonds are $100 million and $20 million respectively. Calculate the WACC for this company if they are subject to a 40% tax rate. In this question, it has mentioned market values and book values. To calculate the weightage of stocks and bonds, we will use the market values, not the book values. Total market values equals $150 million plus $35 million equals $185 million. Weightage of debt, WD, equals $35 million over $185 million equals 0.189. Weightage of equity, WE, equals $150 million over $185 million equals 0.811. WACC equals cost of debt plus cost of equity. Just input all the figures, you will get WACC equals 14.58%. Lastly, I'm going to explain to you weighted marginal cost of capital, WMCC. The WACC typically increases as the volume of new capital raised within a given period increases. For example, the cost of raising $1 million capital will be different from the cost of raising $10 million capital. In other words, as the company raises more and more capital, the marginal cost of capital rises. This is because capital is scarce and limited. In order to get new capital from the market, investors must be compensated with a higher required return. From another perspective, this is true because companies need to raise the return to investors in order to entice them to invest, compensating them for the increased risk introduced by larger volumes of capital raised. When the capital size of the company increases, the risk of the company is also higher, so the return to the investors will have to increase as well. Therefore, WMCC increases. In addition, the cost will eventually increase when the firm runs out of cheaper retained equity and is forced to raise new, more expensive equity capital. Normally, a company will always use its retained earnings first, because the cost of retained earnings is cheaper. After using all retained earnings, the company will have to issue new common stocks to raise capital. The cost of new common stocks is higher. The increased cost of capital is called WMCC, weighted marginal cost of capital. Let's take an example. Current capital structure of a company calls for 45% debt, 15% preferred stocks, and 40% common equity. Initially, common equity will be in the form of retained earnings. After a breakpoint, it will issue new common stocks. The costs of the various sources of financing are as follows: debt, 6.2%, preferred stocks, 9.4%, retained earnings, 12.0%, new common stocks, 13.4%. First, what is the initial WACC? Which will include debt, preferred stocks, and common equity in the form of retained earnings. Second, what will the marginal cost of capital be immediately after that point? In which common equity will remain at 40% of the capital structure, but will all be in the form of new common stocks. For the first part, to get the WACC, we take cost of debt, plus cost of preferred stocks, plus cost of retained earnings, WACC equals 9%. For the second part, to get the WMCC, we take cost of debt, plus cost of preferred stocks, plus cost of new common stocks, WMCC equals 9.56%. Because the cost of new common stocks is higher than the cost of retained earnings, that's why WMCC is higher than WACC. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.